IFRS 17 has been here for a while, and it is one of the most complex standards because it deals with future and involves loads of uncertainty. So let me sum this up for you here. I am Sylvia of cpdbox.com. We help thousands of people to master IFRS, and we can help you too. Just head to our website and sign up to our free newsletter. So IFRS 17 has been effective for periods starting on or after 1st January 2023, and IFRS 4 no longer applies. So let's see what specifically it arranges in some subtopics. First, intro, and here IFRS 17 sets the objective, defines main terms, and it speaks about aggregation and separating components in the contracts. Next, it deals with recognition, so when you should start accounting for insurance contract. Then we have measurement, or the amounts that you should recognize with respect to the insurance contracts, both initially, so when the contract is generated, and subsequently in the subsequent reporting periods. And IFRS 17 guides us in two major approaches, general approach and premium allocation approach. But of course, we have also variable fee approach, modified general model, and other. The next specific topic is modifications and derecognition of insurance contracts. And finally, there's presentation and disclosures. So that's the short overview of what's inside. And now let's see to which type of contracts we need to apply IFRS 17. First, to all insurance contracts issued, including reinsurance contracts issued, but then also to reinsurance contracts held. Reinsurance is simply insurance of an insurance. You also need to apply IFRS 17 to investment contracts with discretionary participation features issued if the company or entity issues also insurance contracts. Please bear in mind that IFRS 17 applies to insurance contracts, not exclusively to insurance companies. Then the standard lists also items that are out of its scope. You can see them on the screen, so always check with the standard for similar items. And here, as you can see, are items that potentially would meet the definition of the insurance contract, but are simply excluded, like warranties. Let me bring your attention to insurance contracts held. So if you buy the insurance policy, you pay the insurance fee or premium, and you get insurance, IFRS 17 does not apply. Nice. Now, what is the insurance contract? The official definition says that it is a contract under which one party, the issuer, accepts significant insurance risk from another party, the policyholder, by agreeing to compensate the policyholder if a specified uncertain future event or insured event adversely affects the policyholder. So let's say the significant insurance risk is a risk of catastrophic floods, and policyholder enters insurance contract to protect its house against floods. Then when there is an insured event happening, like huge storms with floods, the policyholder gets compensation from the insurance company. So it is a risk, not certainty. And then IFRS 17 offers an extensive guidance on the individual components of that definition, like the insurance risk and so on. It often happens that the insurance contract contains something else on top of the insurance, and that something can be embedded derivative or investment component or distinct goods or services. Here, the important thing is that if there is any of these three components in the insurance contract, an entity needs to separate that component if the conditions are met. Separate essentially means that the separated component will be accounted for under a different IFRS standard, not IFRS 17. So we will need to exclude the cash flows related to that component from the contract, and remaining contract will be accounted for IFRS 17. So how? It depends on what specifically the non-insurance component is. So you would either apply IFRS 9 or 15. Now let's talk about grouping and aggregation. An insurer needs to define the level of aggregation of insurance contracts or how they are going to be grouped. Why? Well, because the insurer needs to measure the insurance contracts and their profitability by portfolios or groups of contracts. not individually contract by contract. So we can do that in 3 steps. Step number 1 is perform on initial recognition, and the insurer will assign an insurance contract to certain portfolio of contracts. And portfolio is some larger grouping of contracts with similar risks that are managed together. For example, this can be different product lines like portfolio of vehicle insurance contracts or property insurance contract or life insurance contracts. Then step number 2, divide that portfolio into at least 3 groups according to the minimum requirements in IFRS 17. Group 1, contracts that are onerous or loss-making at the inception. Group 2, contracts with no significant possibility at becoming onerous subsequently after initial recognition. Group 3, other remaining contracts. Step number 3, you need to create separate groups of the same portfolio at least annually so that the contracts within the same group are maximum 1 year apart. There is a full illustration of this concept in the IFRS kit, so maybe you can check that out. Let's talk about the initial recognition. So a group of insurance contracts shall be recognized at the earliest of the following 3 dates. The beginning of the coverage period, which is basically the period during which the insurer provides the insurance services. Then the date when the payment from policyholder becomes due. And if the contract does not set such a date, then it is when the first payment is received. And then for the groups of onerous contracts, the day when the group becomes onerous or loss-making. Remember that we're talking about the group of contracts, not individual contracts, because IFRS 17 is based on the groups. But I need to say that this assessment of the initial recognition is made for the contract individually. Now, how to measure the groups of insurance contracts? There are a few models available, and the primary model is general model. This model applies to all insurance contracts with some exceptions that we are going to introduce, and it does not distinguish between the individual types and durations of the contract, or between short-term, long-term, life, non-life. So it applies in the same way to all applicable insurance contracts. Its main principle is that for onerous insurance contracts, loss-making ones, or those that the insurer right at its inception assumes it will generate loss, IFRS 17 requires recognizing loss immediately at initial recognition in profit or loss. And for other insurance contracts that are profit-making or at least not loss-making, IFRS 17 prohibits recognizing profit immediately, and instead initially you need to recognize it at 0 and any profit along the way as the contract performs, and that unearned profit is called contractual service margin. IFRS 17 then offers a few modifications from this model. First of all, simplified model, which is the premium allocation approach. It can be applied to all insurance contracts that meet specific criteria. And IFRS 17 offers other approaches too. So to group of reinsurance contracts held, we would apply general model with some modifications, or even premium allocation approach with modifications. To insurance contracts with direct participation features, we would apply variable fee approach. To investment contracts with discretionary participation features, we should apply also general model with modifications. So this is just a short overview of different approaches to the measurement of insurance contracts as required by IFRS 17. And let's focus now on the basic components of the general model. So the primary question here is, what are you going to show in the statement of financial position in relation to the group of insurance contracts? In short, one single amount, insurance contracts liability, sometimes asset. At any given time, that liability equals to the sum of 2 components, liability for the remaining coverage and liability for incurred claims. Now, liability for the remaining coverage is composed of 2 parts. The fulfillment cash flows related to the future service. Ensure that would be all cash inflows and outflows related to the group of contracts. And the second component is contractual service margin. That is the profit that the insurer will make on this group of contracts over their coverage period. Let me explain here that the liability for the remaining coverage relates to the future service. So the insurer must estimate a lot because we don't know the future. On the other hand, liability for the incurred claims equals to fulfillment cash flows related to the past service. And here we are basically looking at the past, which has already happened. And the insurer has more clarity about that because he usually knows what insurance events took place and how much it would have to reimburse to its policyholders. So to illustrate this clearly, let's take a look at simple timeline here. Let's say we have the insurance contract that started on 1st January 2001 for 4 years with termination date of 31st December 2004. And now imagine that we are preparing the financial statements as at 31st December 2002. So this is the end of the reporting period in this short illustration. And here, the period from the start of the contract until the reporting date is the past. We have the data, and thus we will measure the liability for incurred claims as a component in measurement of our contracts. The second period after the end of the reporting date, 31st December 2002, until the end of the contract in 2004, this is the future. And we do not know exactly what claims will happen. We can just estimate. So this is our liability for the remaining coverage. And that's very simple overview of the general model. Now, let's take a closer look to the liability for the remaining coverage because this is where we need actuaries. So it is measured as a total of the fulfillment cash flows and contractual service margin. Fulfillment cash flows consist of estimates of future cash flows, which are simply estimated future cash inflows from the group of insurance contracts. That's a plus because they are inflows. They represent mostly the insurance premiums received from policyholders. And then there are estimated future cash outflows from the group of insurance contracts. They are minus because cash goes out. So here we have items like payments of insurance claims, servicing costs, and similar. And since the cash flows happen in the future too, we need to reflect the time value of money. So we need to discount those cash flows to their present value. And then we also need to adjust those cash flows for non-financial risk. And that's why we have a risk adjustment here. And that's also a minus. And as you can see, there is a difference between the plus and minus, and this difference is the contractual service margin. It simply represents the unearned profit from the group of insurance contracts at initial recognition, and it is the negative value of the net fulfillment cash flows. So the total should be 0 for profitable contracts. We teach these concepts on many practical examples solved in Excel in the IFRS kit, so make sure you check that out if you really want to upgrade your IFRS 17 and other IFRS knowledge. The link is below the video. All right, so far we spoke about general model that applies to all insurance contracts with some exceptions. And then there is simplified model, which is premium allocation approach. You can apply this model only to some groups of insurance contracts that meet certain conditions. Either the liability for remaining coverage under this approach does not materially differ from the liability for remaining coverage under the general model. So here you would need to test it and compare it to. Or the coverage period of all contracts within the group is 1 year or less. So yes, you can apply simplified model here too. Application of premium allocation approach is a choice. This is not mandatory, but normally it's quite beneficial to apply it because it's easier than general model. Let me illustrate a bit. So under the general model, you measure the insurance contract liability as the sum of liability for the remaining coverage. That's the reference to the future, plus the liability for incurred claims. And as you can see, we have all these building blocks here that we have learned about already. Under premium allocation approach, it's very similar. So you also measure the insurance contract liability as the sum of the liability for remaining coverage and the liability for incurred claims. But note here that the liability for remaining coverage is calculated without building blocks. It's just the unearned premium adjusted for a few items. So that's the simplicity. And liability for incurred claims is exactly the same as under general model. Again, if you'd like to learn specific numerical example about premium allocation approach, it's all included in the IFRS kit. The last topic I wish to cover in this short summary is presentation. So how we need to show the amounts in the statement of financial position. So here's the extract, and see that there are insurance contract assets and reinsurance contract assets separately from the insurance. And in the liabilities part, we would show insurance contracts liabilities and reinsurance contracts liabilities, again separately. And also assets and liabilities are not offset. That's it. This is simplification from the previous standard IFRS 4, because there you could see many different items. Let's deal with statement of profit or loss. Here you need to present an insurance revenue. That's basically premiums with some adjustments. Next, insurance service expense, like claims and changes in fulfillment cash flows and so on. And the net of insurance service revenue and service expense is then insurance service result. And then we move to the insurance finance income and expenses. And exactly here we need to show the effect of time value of money, changes in the time value of money. So just a few line items in profit or loss under IFRS 17. And do not forget extensive disclosures too. So that's it for this short summary of IFRS 17, but we only scratched the surface here. And therefore, if you'd like to learn more together with numerical examples solved step by step, let me invite you to check the IFRS Kit, our premium course that now includes the full videos on IFRS 17 too. Thank you for watching. Subscribe to this channel and share this video if you find it useful. Bye bye.